We've got, let's see, we've got Henry, we've got Craig, we've got Ron bearish. Okay. Wendy bullish. John is bearish. We've got Greg and Craig, but Craig is bearish and Greg is bullish. Henry's bullish, Daniel's bullish, Mark Bear, Ed Bear, Nate bullish, 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 but slightly bearish. Bullish, bearish. Wow, you guys are like in sequence here. Bearish, bullish, bearish. Okay, let's see. Yeah, okay, Paul. Okay. Slightly bullish, Phil says. Okay. So, I mean, obviously that's a good case study to kind of show where we're at, I think, indecisively. I think I would define myself as cautiously bullish for the month of March because I think seasonally March and April should line up fairly well, but obviously I'm not trading that directionally right now with all of the kind of the craziness going on. If you saw my first message in Telegram this morning, I said, "Hey, we got another good bounce. I just don't think we can trust it yet." And obviously we could not trust it. The Nasdaq is down 1.15%. The SPY is down over percent. I might take a little bullish stab. By the way, here I've been doing that when the market gets oversnapped one direction or the other. Obviously, high risk. Sometimes it just rips down to -2%, like we've seen. But we've been seeing a lot of those kind of snapbacks, and you can make a nice little coin if it even just goes up 0.5%. If you have like a 0 DTE or a 1 DTE. So I might do that here if we hit a little bit lower here on the SPY. But I would say cautiously bullish because of where we are seasonally, the fact that we have so much liquidity that has moved into the market. But obviously, very cautious. When I say cautious, I mean cautious because the volatility that we're seeing right now, like I've continued to say, it's really momentum in both directions. We're seeing very strong moves down. We're not seeing grinds up and then grinds down. We're seeing pullbacks that are taking one day to wipe away 2% of the market, and then if you look at Friday, literally 20 minutes that gained 1.5% in literally 20 minutes. So just kind of the market conditions that we're in, I think, regardless of which direction, you have to be very cautious. Now, one of the things that I think is extremely interesting today as we get started this week is the sectors that are actually driving this. Something that we talked about last week. A lot of the sectors are reasonably centered here. Consumer staples, financials, communications, industrials, even actually here discretionary, not horribly hit. And then we've had technology, which is XLK. If you guys follow the sectors, technology obviously has been what's killing us most of these big drops. But what's interesting about today is that energy has been ripping to the downside since the open. So we're getting a really, really strong push in energy. And of course, XLK, which is technology, and XLE, which is energy, do not typically run together. In fact, you would typically say energy is risk off and technology is risk on. So you would see those rotations happen at almost opposite points of time. Here we're seeing them happen together, at least in a very short term kind of flood to the downside. And so if you look across the market, you'll see the Q's down, like I said, over 1.5 or over 1.15%. SPY down a little over 1%, but it's being driven mostly concentrated by these two kind of odd ends of the spectrum here with technology and energy. And I think what that means for us as traders is you can trade tech and energy, like I have done some, with kind of smaller size and more aggressive trading, specifically technology, of course. Communications would normally fall into that gap, but it's been a little bit more midline the last week or so since the meta drop slowed down. So you can trade technology with kind of those smaller risk stabs, high risk to reward, lower win rate, I would say. Or if you want to be a little more quote unquote responsible, you can kind of trade these middle sectors here. So you can trade a lot of consumer staples like Walmart. I've been trading Walmart a lot, buying and holding Walmart. You can trade some of the industrials. You can trade some financial stocks, which have held up pretty well. You can do that and kind of give yourself a little less exposure doing that way. But the point being, most often what we're going to see drive are the extreme ends of the spectrum. And in this case, obviously, technology once again going to drive us down pretty aggressively. So what does that mean? Well, it means that tech is getting crushed, right? With technology dropping, and we're seeing that just totally destroy the market. Well, not really. I mean, tech is down a lot, but it's basically Nvidia. I mean, there's some Avgo that's down here. Microsoft's about even. Amazon's down a little bit. Google's more communications, but around break even. You actually have more green technology stocks so far than you have red. So not only is it concentrated in technology, XLK, but even within XLK, it's extremely concentrated in two of its heaviest stocks, Nvidia and AVGO. In fact, Apple's right around break even. I might have dropped like a quarter of a percent, but right around break even. And then a fair amount of green stocks. Even AMD is green, for example, which is obviously an AVGO and Nvidia counterpart. Qualcomm, I mean, they're not up huge, but what we're seeing is a very, very concentrated drop in the market. Now that can mean a couple things. What I think it means is that the risk on fear is combining with profit taking on Nvidia. People have been holding Nvidia, whether they need to get out for tax purposes or they're just fearful because the market's getting shaky and they've been holding it since it was $200 or whatever the case may be. I think you're getting a combination of fear on the highest risk assets, which you would think Nvidia and AVGO are both in that bucket. Of course, you would also think Palantir is certainly in that bucket, and it's positive so far. But really, probably more substantial is the kind of risk off when the market is getting a little sketchy like this. And Nvidia represents so much liquidity, so much volume of risk on over the last 2 years. And so the question is, if all this money is sucking out of Nvidia, is it going straight to the sidelines or is it actually going to pour into other stocks? Well, you would think it might pour into energy, but like we just saw, energy over here is actually down. We're all seeing red. So the way that I would handle this is I would wait and I would see where does money enter the market tomorrow? Okay, because maybe there is a lot of profit taking, a lot of risk off still as Nvidia continues, to drop pretty significantly here. Maybe there is risk off. Is this going to go to other medium risk level assets? Is it going to go to IBM and to Apple and to Microsoft? Is it going to go to consumer staples like Walmart and Costco? Is it going to go to high dividend stocks like MO, great dividend stock? Is it going to go to the energy market? Well, energy took a big slump today. Now people say, okay, I yanked a whole bunch of money out of Nvidia. Now I can go ahead and get a little discount on energy. Does it jump into energy? Or does it actually go full risk on? So people take risk on money out of Nvidia and they start slapping it into Bitcoin and Palantir and other risk on, basically saying, hey, we saw the best of Nvidia. Let's move on to another heavy risk asset. Very interesting, I think, what we're going to see over the next couple weeks. And one of the reasons that I'm cautiously bullish is because it is fairly concentrated right now. I don't think that Nvidia is going to pull the whole market down week after week after week. I think that Nvidia could pull the whole market down for 2 weeks, maybe even a month. I don't see Nvidia pulling the market down week after week after week. And so now that I think that we're probably near the end, I mean, there could be another drop in here, but near the end of Nvidia taking a beating here and a lot of just straight liquidity coming off, it's hard for me to believe that that can continue in an aggressive cycle enough to pull lots of other stocks down. And again, the fact that Apple has held up quite well during this turmoil, I think is a very interesting thing to note. So what I would watch for specifically tomorrow, specifically in the first half of the day tomorrow, is what kind of stocks and assets do we see volume get kicked back into, or do we actually see very little extra volume? Because if we don't see extra volume, then you really lean into that risk off approach. I'll give you guys one little trick that you can look at in the market, and just kind of write this down when the market gets really ugly, and use it as a way to help gauge. It's not a perfect gauge, but it's a great thing to add to the repertoire. So if you have a really concentrated day of negativity in the market, so I'm not talking about like the entire market is down 1.5% and every major sector is down. That's not really going to tell you a whole lot. If you see a really concentrated negative day, like we have so far today, where you lose $1 trillion, let's say, across like three stocks, but the rest of the market is maybe down a little bit, but even got some sectors that are up, that kind of thing. If the next 2 days or 3 days you don't see volume pick back up across other assets, what that means traditionally is that people took a lot of money out of mega cap growth stocks and they're not actually comfortable enough to put it back in the market. They're actually keeping it on the sidelines. Maybe they're going into cash, maybe they're going into alternate assets, but they're not comfortable putting it directly back into other stocks. And that's more of a fear indication than virtually anything else when you see, hundreds and hundreds of billions of dollars get yanked in concentrated areas, but they're not redeployed relatively quickly right back into other stocks. Now, if they're deployed right back into other stocks, then you can kind of get an idea. Are they deployed back into medium risk stocks, low risk stocks? Do we see bonds and things like that shoot up? Do we see gold have massive inflows the next week? That will give you a pretty good indication of where the true sentiment is, where when you see, $500 billion get yanked out of the market, and just where does it go back in? And if it doesn't go back in, that should set the alarm bells off. We actually saw that a couple weeks ago, where we saw big drops in the market. It wasn't quite as concentrated as the example that I'm giving, because we had like big macro scares, whether it was unemployment, whether it was tariffs, those kind of things, where you saw a relatively equal liquidity drop. But now we're seeing something more concentrated, and I think that'll be a fairly good gauge in terms of going forward. And we've seen a couple other kind of warning shots fired. Like, for example, Coin smashing earnings. You guys know I took a big position in Coin. I'm down like 30% or something insane in that position. I did sell some really expensive covered calls, which was nice. But other than that, just getting smashed in that Coin. But the fact that Coin absolutely smashed earnings to just an incredible level and went down was a pretty clear warning shot that people were not excited about crypto and risk on assets. I mean, I really should have just bought a put on Bitcoin the next day when Coin smashed earnings. People said, nah, not enough for us. We're actually going to short. That was an obvious sign. We're taking money out of Coin, even though it's killing it as a relative stock performer. That should have been a pretty obvious warning shot that people were not excited enough about Bitcoin in the short term. I should have bought a put right there on Bitcoin, and I didn't. But I think there's been some warning shots like that. Like, for example, NVIDIA solid beat. Obviously, people weren't buying it up immediately at the 4% drop, which if you guys were in the round table, that's something I mentioned. NVIDIA was kind of even on earnings. Then it dropped like 5%, and we didn't see a huge flood of volume back into NVIDIA. What should have happened in a healthy market is an amazing stock like NVIDIA has good earnings, drops a couple percent. You should see all kinds of people stepping in to buy it at a discount with a great stock beating earnings. We didn't see that. We didn't see a whole bunch of buying volume snap in there and grab up NVIDIA. So that's another warning shot. So we're getting all kinds of warning shots here about the shakiness of the market. But the question is, are we getting fundamental bearish market warning shots, or are we getting very concentrating warning shots that are more indicative of a rotation? And I think, I don't have a clear answer on this. I mean, I wish I could give you a super strong prediction on this. But right now, I'm cautiously bullish because I think two things are happening at the same time. One, we had the tech flush out, at least to some degree. Not to say that it couldn't go further. I mean, obviously, NVIDIA could crash 20 more percent, 30 more percent. We don't know. But we've already got a flush out of hundreds and hundreds and hundreds of billions of dollars, trillions of dollars when you add it all up. Plus, we haven't really seen all the stuff rotate into other sectors. So I think that combination of people maybe stepping back into technology while also still having funds that we're going to see deployed into health, into energy, into industrials makes me cautiously optimistic. And then, of course, I personally believe that we're over negatively pricing in tariffs. For that, I'm in the minority. Full transparency, I'm in the minority view on that. Most people would disagree with me. They would say that we still haven't fully priced in long-term effects. I actually think we've overpriced it in, and so that's another reason that I'm cautiously bullish here within the next couple of months. And then on the tariffs thing, actually cautiously bullish longer term. But anyway, I spent way more time on the slide than I was planning on to. My point being, watch the inflows and how quickly they jump back into the market. Okay, hopefully that makes sense. Sorry for spending so much time on that slide. Okay, here's the NASDAQ. Like I've been telling you, I'm watching the NASDAQ. I think for me, it's the more important index right now. I think it should lead the charge based on where we're going to go next. And I think the really big question we have with the NASDAQ is this a retest, or are we basically going to come somewhere down in this zone and move up? Because we've been doing that more aggressively lately, these kind of deep correctional tests. Like we've seen, we talked about this last week here and some other places. This was a great example, by the way. We made this move, right? And then everyone said, okay, we're going further down. And then the market opened down over the weekend and people said, yep, she's dead. And then what actually happened? It went back up. And so you have to be really careful with how deep these tests are being pulled back. And so I would say even if it goes back down to 500, it's not going to tell us anything yet, guys. We really need to see a more convincing, which means we're kind of stuck with our. It's hard to make a lot of action here. We're kind of stuck without some really convincing movement. However, if we get a classic Monday flush and a Tuesday positive move, I'm going to be really tempted to buy. This market's tempting me. If we get a Monday flush and a Tuesday rebound, I'm going to be tempted to see maybe we're getting one of these weeks. Maybe we're getting one of these weeks. I don't know. It's going to be really tempting if we get that tomorrow. So to me, even as ugly as this market is, look, now you see these 3 weekly bars, it's still more tempting to the bullish side than the bear side. Because if we get a bearish candle that continues down here, you're just not going to know anything. It's just not going to be high conviction. Whereas if we get a bullish candle forming, that feels a lot higher conviction just based on what we've seen so far printed out in the last couple of months. So again, that's why I keep saying no man's land. It's hard to get really clear conviction when these ranges have expanded so much. But I think we have to wait and be extra patient. It's always important to be patient. I think we have to be extra patient, and we have to be extra patient to the downside. Now, I have been talking about the Nasdaq. I think leading the charge here. That's what I expect. But I do think there's something that shows up here on the SPY that's maybe not quite as clear on the Nasdaq as a broader index. And I've dubbed this the slowest trend ever? Question mark. Because I've been saying over and over again that since September, we really haven't done anything. We're basically at a net zero. In fact, if you go in here into October, we're slightly down. So we're slightly down over the course of 100 days. And so if you say, hey, over the last 100 days, the market is slightly down, I don't think anyone's going to consider that a slightly bullish trend. But it's just kind of interesting that if you go back to this September range here, where we went from really long. Do you guys remember back in August and going all the way back to April, March, where we had these really long swings? So we'd have like 9 out of 11 days be up 0.5%, 0.7%, 0.8%. Then we'd have more consistent swings to the downside. And then here you see grinding up with lots of gaps, even though the candles aren't that big. 14 out of 17 days going higher. I don't have it fully in the picture here, but here we had 7 out of 8 days going negative. And we were having these really, really long runs that were the NASDAQ moved, I think, 17%, I think it was, in a pretty short period of time. And then we had moves, kind of counterbalancing that, obviously making all-time highs. So do you guys remember that mode for most of 2024 where we were getting longer stretches? We still had pullbacks. We still had deep, like these deep corrections, but the spans in the middle were longer and they were more consistent. Like I said, you were seeing sometimes 15 out of 17 days up, things like that. Well, what I'm wondering is if we're actually still in kind of a similar variety where there's shakiness, there's fear, there's all these liquidity pops, but just like back then when you had these big swings, but it was up, maybe we're doing that right now, but the swings are just quicker and more shallow because this trend, it is up, guys. I know it's weird to say when I just said we're technically negative over the last 100 days, yet if you just kind of pick a point here, this is just a very, very slow upward trend that we're seeing in the S&P. So that's another reason that I'm just cautiously optimistic, that I'm just starting to think maybe the cycles have quickened in the short term and shallowed in the long term. And we're just seeing this kind of lazy move up where this move down, just like this one and this one, is going to get hit and slammed three, four, five, six times, but eventually make a higher high. I mean, as shallow as it's been, all time high, all time high, all time high, all time high, all time high. I mean, they're shallow. They're not much of an all-time high, but they're an all-time high. And so I'm just kind of curious here, obviously, higher low, higher low, higher low, and so far, higher low. So I think this is something you don't really see on the Nasdaq chart as much, but the S&P might be telling us, hey, yes, the cycles are quick. They're quick, 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 but what they're creating is just kind of a lazy, slower, shallow uptrend. So this is something also to keep an eye on, because if we break this very clearly, especially if we get like below 575 on the S&P, I think that kills this narrative. We're not in a slow uptrend by even in Nate's most optimistic view. We are not in a steady uptrend. Even if we just take out this low, I think you could probably confidently say that. So just again, I'm just trying to give you some context here, some interesting things. So the question is, are you, because of this, am I super bullish now? No, very cautious. And yes, I'm still doing covered calls and pair trades because I am being cautious. I think that right now, even though I'm cautiously bullish, caution is baked in here. Now, speaking of pair trades, did anyone do this sneaky trade that we talked about? It was the BITO put and the IBIT call. I actually closed mine out this morning and just started a new one just to kind of reset. So when I checked the market this morning, this trade was up about 1,500 net dollars, which I thought was pretty wild to see. I was honestly hoping for maybe like a 10% gain. That's much bigger than that. A really nice gain. Now, obviously, Bitcoin's not going to jump, 15% over every weekend. So take this with a large grain of salt. But it was really fun to see this in action. Now, full transparency, I don't know if this worked so well because the market prices in some negativity on BITO because it's already known that it underperforms, or if it's actually the true net relative change compared to the implied move. I'm not actually sure. The numbers are really hard to make out here, but it was cool nonetheless to see it, grab $1,500 in a matter of about 3 days, especially considering my options were way out. Like, what were they out? April. So they were out, another 7 weeks. If I would have done short-term options, this thing probably would have been up, 10 grand. Woulda, shoulda, coulda. But I just reloaded another one. Did monthly options again, just kind of rebalanced it right back at the 0 level. Bitcoin's down another 6% since then. So this was an interesting trade to see work that quickly. Now I'm kind of curious to see how it will work a little bit longer term. Okay. Weekend trade idea from last week. It's trying. The Qs are down 1%, but it's trying. XLC opened beautifully this morning. I mean, if anyone took this trade, we couldn't have asked for a better open this morning. It was up, I think, around 80% at about 940, and now it's been beaten back down, but still right around 101.90. So still, XLC is working. It's holding up much better. It's about break even, holding up much better than the rest of the market. But man, we literally made a 2% move between when we placed the trade Friday at 130 and this morning. We made over a 2% move on a sector ETF, which is huge. I mean, that's just hitting it out of the park. Unfortunately, like I said, it's backed off a little bit, but it's trying. It's doing its best to put us in position for a nice winner. If it doesn't make a big move tomorrow, I'll probably just take it off the table here. I like to get out of these trades most often if I don't have a target on them. Most often, I like to get out of the trades by Tuesday or Wednesday. So if it is on the other side of that 103 level, because that's pretty far out of the money, I don't want to just get killed with time decay. So I normally pull those pretty quick. Okay, Ray got 56% on XLC. Probably closed it then this morning. Good job, Ray. We'll see how it goes tomorrow. I'm cautiously optimistic on a continued bounce back. Like I said, I'm kind of crossing my fingers, which is not the way to trade, but just as a macro point, I'm kind of crossing my fingers that we're getting, more of a typical Monday flush, and then we'll actually have a pretty good day tomorrow. So we'll see if that happens. In this market, I'm not betting on that. I'm not putting any bullish trades on. particularly based on that narrative, but I'm just kind of crossing my fingers that that's the kind of action that we get. Okay, weekly watch list for you all. Okay, so I've got LLY. I've been liking health, bouncing back here. I'm cautious with health once again. I do believe that RFK is a negative catalyst for health, and that over 4 years, that the health sector will probably underperform, assuming those initiatives are successfully achieved. Because I personally think that health was trending like technology. Like health was really killing it and was primed to outperform, especially in the Biden administration and what they were able to do. And now I think that's taking a hit. So for me now, I like LLY. It's a great stock. I'm a little more cautious with it than I probably would be otherwise. But that's one that makes the watch list. I think we could legitimately see that um, take a nice bounce and potentially get to all-time highs, which would be a great move. Like Apple, like I've been sharing, and Meta. These are my two Mag 7 right here that I'm trading more aggressively. If you're a Mag 7 person, I am. Again, I have to say it after everything I say now. Cautiously right now, a Mag 7 person. But I think Apple and Meta are the two best. I've talked about why in the past, but essentially, I think they have the most stable AI potential. NVIDIA obviously has incredible AI potential, but it also is not stable AI potential. So NVIDIA, is relying on many pieces of the equation to put them in the right position. So far, they've done a great job of that and been an incredible stock. Apple and Meta, I think, almost don't matter how AI shapes. They're going to be at the center of it either way. And so I think they're the most stable AI opportunity. If you've heard me talk about AI, you know that I believe AI is legitimate. It's a game changer. It's going to be worth, hundreds of trillions of dollars and some crazy number that we can't put a value on over the course of the decades. It might hit a short-term bubble. We might see all stocks that are associated with AI go down 50% this year or next year or the year after. But I think that it's exactly that. I think it's a short-term bubble that does not represent the reality of the value of AI. So I'm an AI believer, regardless of what happens in the short term. Like Walmart, like I've been sharing, it's down today, so I'm tempted to grab some more, but I'm already pretty loaded up, so I probably won't. But continue to do those investing 2.0 style trades on Walmart. Gold is interesting. GLD is the one that I typically trade. Really overperforming, obviously, like on a day like today and a couple other gap ups, but still should be at all-time highs, if you ask me, and it's not at all-time highs. So I think it should be at all-time highs, and therefore I think even though it's gapping up and looks a little overextended, if you go to a short like hourly chart or something like that, I say it's undervalued over the course of weeks and months, and so I like gold. And then Nike is one that I think is interesting to the short side. So speaking of some of these stocks that are kind of interesting, I think that AVGO earnings should be an interesting kind of counterpart to the NVIDIA earnings. I would expect similar kinds of responses around AVGO, where it really needs to put up some spectacular earnings to move people to a high, outperforming mindset for anything tech right now. Costco, I like, and they'll be curious to see if it impacts Walmart. CrowdStrike, this was my number one stock going back to October, and performed really well. Now I'm a little more risk off on it. But, again, anything technology I think is going to have to really outperform. And then a couple other ones. I mean, Target I think will be an interesting one as well. Again, see if it sheds any light on Walmart and some of the other consumer staples. This is Target is a defensive like Walmart, like Costco, where you don't expect it to have negative sentiment around around tough times, and Target has not lived up to that demand as much over the last year as Walmart and Costco have. And then of course you got some fun ones in here. HP has been a fun one. Best Buy has been a fun one. AutoZone's been a great stock, by the way. Marvel has been a really big mover. I'm not sure what the expected move on Marvel is, but probably significant. So there's a couple fun ones mixed in there as well. Okay, and then one other announcement. I'm going to do a live overnight options trade today. I haven't been able to do a live over an option trade in a little while. I'm going to do one today at 3 p.m. Or excuse me, at 3. Am I going to do it at 3 or 3:30? I'm going to do it at 3, but I'm going to go pretty quick. Just the live trade. Get in there, answer Q&A just to do that because it's been a little while since we've been able to do an overnight option trade. If you are not a member of Overnight Options, jump on in, be a member before we go live today at 3. As a matter of fact, before I log off, we'll go ahead and stream that presentation one more time for anyone who has missed the chance to check out Overnight Options. I've been beating it like a dead horse the last week, so you probably have seen it. But if you haven't seen it or haven't got a chance to join, stick on for another 50 minutes. We'll just play it right here through the Zoom room, and you can watch the entire presentation of Overnight Options if you want to do that and check it out before we go live. But I just wanted to mention for all of you who are members, so you heard it from me first, live trade today. Keep an eye out for your members area. We'll do that. By the way, we talked about last week drawdown and handling when the market goes against you. I talked about it today in my newsletter as well. But obviously, this is where the rubber meets the road. Mechanical strategies like overnight options. We took a hit, took some negative trades. Then we won 3 in a row last week while the market was absolutely falling apart. And that's the kind of stuff that I'm looking for. It doesn't mean I'm going to win every time. We talked about drawdown, what that looks like last week. If you didn't check out Friday's session where I just really walk through what drawdown means, how to approach it as a trader, what I've learned about drawdown, I thought that was a really important session for anyone who's serious about trading and investing. So if you didn't see that one, I recommend it. But again, this is where the rubber meets the road. It's trading mechanical strategies like overnight options where we legitimately keep swinging the bat. So if you guys want to stick on, we will kick that off. We'll just stream it right here in the same Zoom room. You don't have to go anywhere. And then it gives you about an hour to go through it and join because our live trade won't actually start until 3:30. So I'll be on around 3. You have about 90 minutes from right now to become an Overnight Options member to be part of our live trade here today. So hope you take advantage of that. Otherwise, thanks for jumping on the Mapping the Market session. Hope it was valuable. Hope you made some money on XLC. Hope you made some money on the BITO IBIT pair trade. And if none of that, I hope you just got some valuable lessons from hanging out with me today. I wish you the best, and I will see all of you for Overnight Options. Don't log off if you haven't seen Overnight Options yet. We're going to play it right here.